Very warm and good morning to one and all. We at Kanwala Securities welcome one and all and thank you all for joining us on the Saturday morning to have a glimpse on what has been in CY 2022 and what we can expect in CY 2023. Calendar year 2022 has had its own challenges, advantages, disadvantages. Capital market has seen a relatively flattish movement. We went to a high of 18,800 and 17,800 has been a very crucial level. We all have heard and understood that India is in an Amrit Kal, and to medium to long term perspective, we all expect the capital markets to do very good. But very frankly, all of us are here to make money. And when we want to make money, we are also looking at a medium to short term perspective. Whereas 18,300 is showing a little bit of a resistance, 17,800 is a strong support. So we are in a very narrow zone. Next 2 to 3 weeks, we perceive might be the barometer which will decide what and how much returns can an investor make in calendar year 2023. To take you all through the entire journey of what was there in 2022 and what will happen in 2023, we at Khanwala Securities have our entire team of equity capital markets and our research team. Let me take a minute to introduce my team who's there on the panel today. And rather than having a straightforward presentation, we will have it more in form of a Q&A with them, wherein they will answer most of the questions which each one of you and me have in our mind. To start with, we have Mr. Pranav Khandwala, who is the whole-time director of Khandwala Securities. He has over 2 decades of experience in equity capital market and has been instrumental in creating and managing strategic business initiatives, resulting in enhanced business and opportunities and value creation for everybody. He has done his master's in business administration with dual specialization from UK. We have Mr. Ajay Ladda, who is our CEO and heading our broking activities. He's a cost accountant by qualification and brings in over 3 decades of invaluable experience in the field of investments and capital markets. With an unparalleled passion and the grit for the investment profession, he has been able to successfully create long-term wealth for investors over the decades. We have with us Mr. Samir Kulkarni, who is head of research. He is an MBA with specialization in finance and brings over 2 decades of experience in equity capital market research. We have Mr. Rishikesh Joshi. He's a portfolio manager, an engineer and MBA by qualification with over 15 years of experience in portfolio management and equity research. We have Mr. Sonal Singhi, a competent professional with over 15 years of qualitative experience in technical analysis and portfolio management. He is working as a technical analyst and portfolio advisor with Khandwala Securities for last 13 years. And last but not the least, we have Mr. Nirupam Nathani, who has a deep understanding of financial markets, has an experience in markets, and has consistently helped with wealth creation for our clients. He is our mutual funds expert and a certified financial planner. Can I just request all the participants to mute themselves so that we don't have too much of disturbance in the discussions? And we will be taking all the questions at the end of the session. So whatever questions you all have, you all can put it in the comment section and we'll take it up at the end of the session. Just to give you a perspective of where we want to start, capital market CY 2022 has been a year full of volatility, where Indian markets has outperformed the global markets. We have delivered a positive 1% return as compared to negative returns by the rest of the world. Global market digested big events like Russia-Ukraine war, COVID, monetary policy tightening, technology meltdown in US. Value stocks and sectors like PSU banks, metals, manufacturing, infrastructure, and automobiles have done relatively well. On the other hand, sectors like IT, pharma, consumer stocks have struggled a little in the last calendar year. To understand what and how things will happen, let me just start with asking Ajay sir a couple of questions. Ajay sir, 2022 has been hit by a series of challenging factors like high inflation, high interest rate, tightening financial conditions, and geopolitical uncertainties. What should the investors expect on the inflation front in the calendar year 2023?
Yes, good morning to all our investors and wishing you all a happy new year. Like you said, 2022 was a very tough year. Uh, you saw oil moving from around 70, 75, $80 to around $120. But the good thing is that it has come back now to that band of 75, $80 where it was before Ukraine war started. Uh, Another important commodity which affects inflation globally is natural gas prices. And these shot up from around $3.50 before the Ukraine war to over $9.50. But in the last 2 months, they have also come back to around $3.50. Most of Europe uh, functions on natural gas both for heating and for manufacturing. Another important aspect is which is affected global inflation is your shipping costs, and these have moved from around $2 pre-pandemic for a 40 foot box to around $9 during Ukraine war. And luckily, even these have come back to around $2.5 now. So three important commodities: oil, natural gas, and global shipping costs, after spurting very sharply last year, are now starting to come down, and this will have an impact on inflation in the coming few quarters. We can also see that in the US, inflation had peaked at around 9.1 in June, and in the latest month of December, the inflation figure was only 6.5%. So 9.1 to 6.5 is a reduction of almost 3.5%. And in India also, we found that inflation peaked at around 7.4 in September, but in December we had only 5.7. So the good part is that the worst seems to be behind us, and also because of the high base effect, our belief is that inflation will keep coming down every month going forward, and that is the good news for us.
Great. So, Ajay ji, along with inflation, another biggest risk that the investors had in their mind has been the rising interest rates. Uh, Throughout 2022, we have seen Fed increasing the interest rate and the consecutive effects on the global market. What is your outlook on interest for the year 2023? Do you see it easing out, or do you see still some pain left?
That's right. So interest rates in the US went up from close to zero to they're almost now 4.5%. Uh, this has had a huge impact on the economy. So uh, an average person who had taken a home loan, his home loan rates have gone up from around 1.5-2% to almost 6.5-7%. So his EMIs have almost doubled, and that is not good. So if my EMI has doubled, it means I have less money to spend on other consumer durables and other rest of the consumption basket in the course of the month. Luckily, now with inflation peaking out, our belief is that the Fed will at the most make two more rate hikes. So we will move from maybe 4.5 to 5%. We have had four rate increases of 0.75% each. So we are almost at the peak of that interest rate cycle. And our belief is that as interest rates come down and Fed believes that this is sustainable, we will see interest rates coming down in the second half of the year, and from maybe 5% to around 4.5%, and maybe to around 4 to 3.5% next year. So the good news is that interest rate cycle looks like it has peaked, and we will see interest rates coming down in the second half of the year and next year. And equity markets have a very close linkage to interest rates. When interest rates go up, it affects the economy very badly, and makes investments in debt more attractive compared to equity. And also it affects the valuations of stocks, especially growth stocks, very sharply. So the way you value stocks is that you add up their cash flows over the next 20-25 years and divide them by the interest rate. So that is what we call the discounted cash flow method of valuation. So if, let's say, uh, you added Google's cash flows and the value of all the cash flows over the next 25 years was 100 rupees, and you divided it by 2% earlier, so the fair valuation was 50. But if interest rates go up to 4% and you divide this cash flows of 100 by 4, so the valuation of Google now will be only 25. So with interest rates coming down, we believe that growth stocks, the valuations of growth stocks will improve in the second half of this year and sharply over next year. So this interest rates and stock market valuations are very closely linked, and our belief is there is good news in the second half of the year on this front. Thank you.
Great, great. Thank you, Ajay bhai. Now, when we understand interest rate inflation, the next question that comes in everybody's mind, will India outperform the global markets again in calendar year 2023? Or do we think that the higher valuation and opening up of China will have some impact, and what will be the impact by the FPI flows in in this calendar year? Can I call upon Samir to shed some light on this?
Thank you, sir. Welcome all the investors. So our view remains that Indian equities, they have outperformed in calendar year 2022 because of its strong GDP growth, what we are seeing in India compared to the rest of the world, the strong GST collection, the manufacturing PLI scheme benefits which Indian corporates are having, a strong revival in banking sector, and growth in auto and real estate sales. So based on this, we have seen an outperformance of Indian markets, and because of that, if you see the valuations, they have now come to 7 to 8% higher compared to long-term averages. So that's why we are seeing Indian markets compared to world standards, which are trading at compared to long-term averages, they are at long-term average or below long-term average. In India, Indian markets are trading 7 to 8% higher compared to our long-term 15-year average. So that's why we are seeing, if you see globally, S&P 500 valuations, they are trading at last 25-year averages. At the same time, if you see global markets like US, Japan, Europe, emerging market and China, the emerging market and Chinese equities are trading lower compared to its 25-year averages. That's why we are seeing the money may flow from India to the rest of the world, like emerging markets and China, as there the valuations are reasonable compared to long-term average. Even Europe, as Ajay sir rightly pointed out, the natural gas prices have corrected quite sharply, helping European countries to benefit from it. That's why we feel that the valuation which are reasonable in Europe, they may also see FPI flows. If you see in last this chart we are showing for last 6 months now, India has seen a sharp increase in FPI inflows from 7.7% in 2020. India's share has gone up to 14.8. But we feel that China's market share, which has come down from 36% to as low as 26% in September, that has gone up to 30.4% in November now. So countries like China and Taiwan may also attract liquidity, and there may be a mild outflow from Indian equity markets in CY23. So that's our perspective on the flows and the valuations of Indian markets.
Great. Thank you, Samir. Having understood the broader perspective, how do you, next question that comes in an investor's mind is going to be, how do you see earnings growth for the Indian corporates for calendar year 2023, and which sectors you are bullish on and why? Can I call upon Rishi to share his inputs on the same?
Yeah, hi, thanks. Good morning, investors. So, in terms of earnings growth, we expect 12 to 14% of earnings growth this year as well. But in terms of sectors, there are certain sectors which are looking quite bullish, which we continue to like in recent past and even now. So one of the sectors is the banking and the private sector bank, select ones, and the PSU banks. So PSU bank has gone through a rough phase for last 7-8 years. Since last 6 months, they've started picking up, but relatively they're in much, the valuation wise, they are still at lower levels. So we feel that, with the credit cycle, started to build up and the asset quality is improving and has improved. So the PSU banks and select private sector banks with lower valuations are something which will really gain this year as well. Apart from that, manufacturing is a sector which we continue to like because of clean focus by the government of India on ensuring that the manufacturing is kind of into getting more and more into the Indian economy. With the manufacturing also, telecom is another sector which we are really bullish on, because telecom has gone through a bad phase for last 4 5 years. Between that you could see that between Reliance and Bharti and the other participants, there was a lot of price war. Now this price war to some extent has cooled, and the ARPU increase has started to begin, which eventually will kind of get better and better in terms of how the telecom as a sector will evolve. So we are also bullish on telecom as another sector. Apart from that, we are also bullish on IT. Of course, IT now can be accumulated, but we feel that there is still some pain which is left in IT, and investors should consider IT after next 3 to 6 months. So second half, especially for second half of this calendar year, looks better for IT companies, especially the ones which will give growth. Apart from IT, we also continue to like FMCG, but in the later part of CY23, and that is because of the next year being the election year, government will have a lot of focus on the rural portion. That's where the FMCG companies come into picture. So second half of would be really good for the FMCG companies, considering the next year is an election year. So these are broadly the sectors. But apart from that, we would also we also like some asset classes, and which we feel would be should be a part of the portfolio. One of them is the gold. So gold has done well in recent past, but because of the volatility that we expect in the recent in recent terms in markets, we feel that gold for next 3 to 6 months to 1 year, in fact, would be a very good outlook that we should have, and we should have that position in the portfolio as well for the gold. Apart from that, the global equity has gone through a rough patch. We know that what happened to Nasdaq, what happened to Dow Jones. They're still not really completely out of the woods, but right now the valuations are much attractive, cheap, and that's the reason we continue to feel that we should look in and invest in the ETFs or fund of funds, which is there in for the global equities, be it in the Nasdaq ETF, be it in the S&P, be it in, let's say, in some other developed markets like Japan, and of course China, because again has very kind of gone through bad phase as well. So in short, this is what our view is in terms of the sectors. Thanks, Rino.
Yes. Thank you, Rishi. We have tried to understand the important factors and important things. Also, one more question which comes in everyone's mind when we talk of Amrit Kal and the decade belongs to India. Why do we actually feel that the decade will belong to India, and what are the key drivers that will ensure that this decade belongs to India? I'll call upon Samir to give his inputs on that.
Yeah, thank you, sir. So we strongly believe that this decade is a golden decade for India. The major reason for this is the demographic dividend that India has. If you see the working age population that is going to be added from 2022 to 2031, India is going to add 91 million workforce in working population. That is 21% of incremental workflow addition in this next 10 years. This demographic dividend that India has will result in a strong upsurge in the income levels of Indian people. So if you see 2021 household by income distribution, $0 to $5,000 per capita income category has number of households around 112 million, which is around 38%. 5 to 10,000 has around 36%. 10,000 to 35,000, we have 24% of households, and above 35,000, we have only 2% of workforce. But in next 10 years, we believe that India will have a bulking high income households. So 5,000 to 10,000 income range will go to 34%, and at the same time 10,000 to 35,000 will go from 24% to 46%. This is a massive jump. So if you see number of households in this category will go from 70 million to 165 million. That is a very, very strong jump. At the same time, above $35,000 per capita income the percentage will go from 2% to 7%. So this high income consumption driven population is going to have a very massive impact on India's consumption drive. And we feel that if you see India's consumption basket, like whenever your per capita income goes up, your roti kapda makan expenses remain the same, but your discretionary consumption spend goes up very sharply. So consumption spends on painting your house, buying a new mobile, buying a new luxury car are going to go up very sharply in next decade. That's why this slide we have taken from Ridham Desai's Morgan Stanley report, and he's having a very good outlook on Indian economy over next one decade. So there are three pillars to this assumption. One is the government policy change. Like 2 years back, we have seen Indian corporate tax rates have been cut by the government. Government has come up with almost 50 production-linked incentive schemes in India, and infrastructure spending in India is going up very sharply. That is resulting in a strong corporate profit to GDP growth in India. This is one of the strongest pillars in India's growth story over next one decade. At the same time, the multipolar thesis that we have earlier, what was happening is US was a consumption economy and China was a manufacturing hub for the world. But post-COVID, the manufacturing base is changing, and world now wants China plus or Europe plus strategy. That's why you're seeing manufacturing is becoming more and more focus area for Indian government to improve manufacturing's share in its total exports. That's why we feel that China, say, manufacturing can shift to India, and as India's consumption economy is going to improve, as the number of population in that bracket is going to improve very sharply. That's why we feel that manufacturing and consumption in India will have a very strong run up in next 10 years period. At the same time, the India digital stack, the kind of work Nandan Nilekani has done on the India digital stack, like linking of your Aadhaar, eKYC, DigiLocker, e-sign, which I came to know that nowhere in the world you can sign the papers in the cloud. The payment layer like UPI, FASTag, the kind of work government is doing on this India digital stack is a massive transformation in the credit history of India. They are now getting your unorganized thelawalas or a chai wala into the formalized economy through tracking his UPI transactions. So earlier in India, if you see, we were having an asset-based lending model, but now these thelawalas or chaiwalas, the smaller chaiwalas, they don't have any asset to back their cash flows. So based on their UPI transactions now, government is going to give them loans based on their UPI transaction and GST payment what they have done. So this is a very, very strong transformation in India's digital history that will drive the growth in India's lending side. So that's why we feel that India will have a very strong decade over next few years. And India's GDP will surpass 7.5 trillion by 2031. India's market cap will grow at 11% per annum, because nowhere in the world investors can ignore country like India, which is having a very strong population growth in the higher income category. If you see now, Louis Vuitton and Cartier are having Deepika Padukone as their brand ambassador. That shows the strength of India. At the same time, manufacturing share of GDP will rise to 21% by 2031. And the export opportunity is also very strong. The per capita income in India will go from 2,278 per person to almost 5,200 USD per person. This will boost the consumption space in India. At the same time, the credit to GDP will grow from 57% to 100%, implying a compounded annual growth in credit at 17% for the next 10 years. So based on this, we strongly believe that next decade belongs to India.
Great, Samir. Thank you. In this calendar year 2022, we have seen that the banking sector has outperformed. Do we see this trend going forward? This is a question that everybody has. Can I call upon Ajay sir to share some inputs on the same?
Please, my belief is that the banking sector has done this well this year after underperforming the market over the last 3 years. And it has particularly done quite well over the last 2 quarters. Uh, this was led also by PSU banks, which had not gone anywhere over the last 10 years. So some of the reasons for this outperformance was that one reason for this outperformance was that credit growth improved from around 7%.
Yeah, Ajay,
Our
please go.
bank, our banking system had accumulated a lot of NPAs in the last credit boom, and NPAs for banks in the PSU banks had gone up to around 10 to 15%. In the private sector banks also, NPAs had gone to around 6-7%. But there was a big cleanup in 17, 18, 19, and also in 20, the banks made huge provisions for COVID, but these provisions were not required. So now our banks have a very clean balance sheet, which we have not seen in the last almost 2 decades. And now NPAs in the system are at almost 1.5%. Even in public sector banks, NPAs are around 2%. So if you see for a public sector bank, out of 100 rupees of profit, almost 60-70 rupees was going towards provision for NPAs. So what was left was only 40 rupees of net profit. Now out of 100 rupees, only around 30 rupees is going towards provisioning. So what is left is 70 rupees of net profit. So for public sector banks, we believe that the next 2-3 quarters will again be very strong with profits going up very sharply. And we expect banking to continue to be outperformer again even this year, at least especially for the first 2 to 3 quarters. NBFCs have not done well this year because the profit of banks went up very sharply. Another thing was that aided banks was that in banks, when RBI increases lending rates, you are able to increase, when RBI increases your rates, the very next day they increase the rates that they charge to lenders. But on the deposits, which are, let's say, 1 year deposit, 3-year deposit, 5-year deposit, the rates go up only when the deposits get over. So this year, the margins of banks have improved by almost 60 to 70 basis points because interest rates went up by 125 basis points, but your deposit rates didn't go up. So deposit rates will slowly go up. So banks, their margins went up from 300 basis points to 360 basis points. But for NBFCs, their margins could go up. So a lot of money flowed from NBFCs to banks, and also because valuations of NBFCs were higher and banks were lower. However, in the second half of the year, we expect that deposit rates for banks will go up, and the net interest margins of banks could come down slightly, and for NBFCs, the margins could go up. So while banks could perform very strongly in the first half, we believe that NBFCs could catch up in the second half. Thank you.
Oh, thank you, Ajay. So what are the key risks and concerns that investor needs to keep in mind in calendar year 2023? Can I call upon Rishi to share his inputs on the same?
Yeah, sure. So, first and foremost, the Fed, what actions does it take? Because Fed is the one who drives the global liquidity and global interest rates. So, what kind of comments, what kind of actions they do take on their quarterly call is something which is kind of a key concern that we all have on how it really be a part of the global economy. Secondly, there is an expectation of mild recession in US. So if this mild recession to some extent becomes worse than expected, then that's the challenge that we will have in terms of how things will shape up. One of the key problems that we faced in last couple of years was on supply chain disruption. And we had seen how the kind of details, about the availability of components and so on and so forth was there. So in such case, if there is a supply chain disruption which will happen still further because of some other reason, then that also is one of the reasons that we really concerned about. And also the geopolitical concerns which have been there for quite some time, looks like they will ease out, but we really can't comment on how things shape up. So that's another key worry here that we have. Thanks.
Okay. Having seen what are the fundamentals, how the markets are expected to perform, what sectors are expected to do, one obviously wants to understand technically where do we stand. We have seen a high of 18,800 and we are seeing some resistance and some support at 17,800. Let me call upon Sonal to share his technical view on S&P, Nifty and Bank Nifty.
Hi, uh, a very warm welcome to all investors and a very happy new year at the same time. So, broadly, when we start with Nifty, Nifty at the current juncture is trading very close to 17,800. And past many weeks, what it is doing is that it's trying to hold on to the 17,800 support. So it's a good sign that we are seeing the Nifty holding a very critical and a strong support. And what we expect is that it should again take out resistances on the higher side. So taking support is half of the job done. What it should do is it should be able to take out resistances so that people get more interest and momentum will also get attached to it. So what we are expecting is if 70,800 holds, which is the first scenario, and we are banking on it, we would see 18,300 a bare minimum. And even in other normal circumstances, we will not be surprised if 18,600 is also tested. Now the challenge begins at 18,600, whether or not Nifty sustains above 18,600. So that will be a question to be answered later on. We'll see the price action closer to those levels and take a view thereon. But 17,800 is a critical support, 18,300 and 18,600 are the targets on the higher side as of now. At the same time, like if we see 18,600 being taken out, then that will be a win-win situation for the bulls. And we could also see the earlier targets which we had revealed in the last webinar, close to 19,200 and 20,800. So the first target of 19,200 was like left short by a very small margin. 18,900 was the high. And the second scenario is that if what if we break on the 17,800 support? So in that situation, the buyers will command the scenario and easily drag the Nifty close to 17,000 and 17,300 supports. So our bias is, however, on the higher side. We expect the 17,800 to 800 support to hold on to. And there are a couple of reasons. The first reason is the Bank Nifty. So if you go to Bank Nifty, what Bank Nifty has done, it is still trading above the last October highs, which Nifty was struggling to get past through. Bank Nifty currently is still above it, not by a very wide margin, but it is sitting above it. So the expectation from the Bank Nifty is still high, and it has delivered in the past, and we expect the same going forward. So what we want is that Bank Nifty should not be breaking the support of 41,800 on the lower side, and eventually take out resistances on the higher side. So Bank Nifty should hold on to the critical support of 41,800. That is half of the work done. On the higher side, both these psychological resistances of 43,000 and 44,000 hold some significance, and that those will be the minimum targets. In fact, we are expecting much out of it. So let's see the price action closer to these psychological resistances. If 41,800 gives up and that's will then take over the situation and pull even Bank Nifty down to as low as closer to 39,000. So we are having a positive bias as of now, and we are expecting much out of Bank Nifty. Bank Nifty will be the one which will be deciding the way ahead, and also at the same time, what we have seen is that S&P was earlier struggling close to the 3,750 to 3,700 mark. But for the past 6 months, what it has done is that it somehow maintained the support levels. And now, just for the last couple of weeks, what it has done was that after the buyers are getting tired and they are not able to reach below the 2750, 2700 range. So what we have seen is some buying seen, and at the current juncture, exactly at this point in time, where S&P is at 4,000, there is a falling trend line, and it is trading at that pinpointed resistance level. So that falling trend line stands from last year highs. So a very critical level which we are trading at as of S&P 500 is concerned. And what we read into it is that as long as 3,900 is intact, we see this resistance to be taken out eventually. Also, about 4,100 levels, there is a pattern breakout of an inverted head and shoulders, which when confirmed, we will be seeing a swift run up on the S&P also. So fingers crossed, let the first phase support level of 3,900 hold on to, and the problem in S&P will start only if we break below 3,700, 3,750, which is a distance now at a small distance away. So we don't expect it to reach anytime sooner, but let's see how it reacts and breaks and behaves closer to the races. That's it from my end. Thanks a lot. Thank you.
Thank you, Sonal, for your views. Now, with budget just around the corner, each and every investor, including me, will want to understand what is our budget expectation. Can I call upon Rishi to give his inputs on the budget expectation that an investor should have?
Sure. Thanks, Rina. So uh, clearly, being this being next year being the election year, so government's focus would be more on how the rural thing happens. So the rural, like FMCG companies, and there will be a lot of spending actually, and which will kind of benefit the rural population as such. So that would be a one clear focus. Another would be the capital expenditure, which they have been doing for quite some time. And that's the reason why even now the capex looks very good for us, capex and the manufacturing sector. Thirdly, the macro stability. So government, this being an election year, will look to focus more on the macro, and that's where the concern is there, and that's the reason why they'll be able to address it predominantly. So these are basically 3-4 things that we feel that would be the kind of budget expectation we should have. Thanks.
Thank you, Rishi. When we understand the capital markets, one of the major areas is how mutual funds and how debt funds and how FDs are panning out. Can I call upon Nirupam to share some inputs on with FD rates becoming so attractive? Should investor look at debt funds at this point in time?
Good morning, investors, and wish you a very happy and prosperous new year. It's a very important question you have asked, sir. So, given the fact that interest rates have picked up globally and in India also, we feel that we are closer to the peak. We would strongly recommend investors to do consider investing into a debt fund. So, so the only advantage, over FD is the taxation, which makes debt fund more and more attractive, especially for those investors who fall on a high tax bracket. So just refer to this slide. In the second column, the interest rate on FD is for 36 months is around 7.5% and annually compounded. After paying tax, the net tax rate comes to 5.07. Had the same investment gone into a debt fund, just refer to the last column, the 36 months investment into a debt fund at 7.5 gives you entire 7.5 after 3 years. It is due to the tax. In debt fund, we have to pay tax at 22% only on the real return, which is over and above the inflation. Whatever I earn, I have to pay tax on that amount. So that makes debt fund more and more attractive. We would highly recommend our investors who definitely fall on high tax bracket. This is certainly a good time to consider investing your debt fund, because if you invest now, though you are going to invest for 3 months for this financial year, you are going to get the indexation benefit for entire 1 year. So which makes more attractive at this point of time. Thanks.
Nirupam, when you say debt is an attractive sector, attractive thing, also as an investor, I would want to understand which categories of debt one should look at and what are the risks or what are the perception that an investor needs to have. Because the last 2 years, I don't think so investors made good money in debt as a category.
Yeah,
So what
you
is
are
your
absolutely
take on that?
you're absolutely right. So at this point of time, we would recommend our investors investing into a dynamic bond category, which typically invest in government bonds with higher maturity, say between 3 to 10 years, and accrual paper. And within these two categories, the fund managers take allocation depending upon the interest rate cycle. And the second category is the target maturity. Target maturity buys all government of India enterprises papers like NTPC, Rural Electrification Corporation of India, Power Finance, NABARD, Indian Railway, and state development loans, which are 100% secure. This could be a good category to consider for next 3 to 5 years kind of horizon. And yes, you are absolutely right. Last 2 3 years, the investors had not made much money in the return in the debt because the interest rates were multi-year low. Now going forward, as the interest rate has moved up, we feel that this is a good time and investor could make something like between 7 to 7 quarter post tax in a debt fund. And I think especially after Franklin fiasco, most of the fund managers have made the portfolio safer and high liquid through investing in only into a AAA rated companies. That eventually makes debt more attractive at this point of time.
As an investor, I am a hardcore equity player. So if I look at calendar year 22, calendar year 23, if I have to invest in mutual funds, what are the sectors what are the kind of mutual funds categories that I should look at, and what should be my investment return expectation in CY 23? Nirupam, what will be your take on that?
Okay. So this is also a very important question you have raised. Which category to get in? Large, mid, and small. Under such a scenario, one could give preference to a multi-cap or flexi-cap category, because in multi-cap, fund manager invests fixed percent of allocation between large, mid, and small cap. Whereas in flexi cap category, investors or investment happen only into large, mid, and small cap, and fund manager has the flexibility to move between 10 to 70% between the caps and vice versa, from 70 to 10, vice versa, between large, mid, and small. And we would recommend, we think that we could expect something like 12% return over next 3 to 5 years, which is nothing but the nominal GDP growth rate of 8 to 9% and inflation of 4 to 5%.
Okay, great. So with this broad perspective, what we have got on equity markets, mutual funds, debt funds, how do we invest, what do we do, what should we be expecting in 2023? If I try to summarize or if we try to understand where we stand, 2023 might have its own challenges, but when there are challenges, there's a lot of opportunities which are there. And we as Khanwala Securities always look at opportunities and how we can add value to our investors when there are opportunities of volatility in the market. With this, we would want to throw the floor open for Q&A from our participants and investors. If you all have any questions, please raise your hand or put your questions in the chat box, and we'll try to take all the questions as much as possible.
Renu sir, we
Hello.
have questions in the chat box.
Yes.
So can we start taking them?
Sure.
Yeah. So the first question goes to Ajay sir. The question is, which specific banks will perform better in CY23, and your outlook on especially Bajaj Finance? Thank you.
My view is that the PSU banks will continue to perform well in the first half of the year uh, because their profits will show almost 100 to 150% growth. Like I said, for PSU banks, the profits could move from, I said earlier, out of 100 rupees, 70 was going towards provisioning and only 30 was the net profit. Now, out of 100, only around 30 is going towards provisioning and 70 is the net profit. So, for PSU banks, you will see profit growth of 100, 150%. Also, banks like HDFC Bank, which have underperformed very sharply for the last 3 years because of the merger. The merger should get over this quarter and they should now play catch up. Uh, Other banks like Axis Bank and IndusInd Bank also, which performed badly for the last 3 years, could play catch up. So last 3 years, you'll find that the ones which performed well was ICICI Bank. So that might take a breather. And PSU banks like SBI, Bank of Baroda, in the large banks, HDFC Bank, and in the private sector banks, banks like Axis Bank, these could perform better this year. Also, my belief is that this year, a lot of money went out of NBFCs like Bajaj Finance and banks with higher valuations like Kotak Bank to the PSU banks, which had underperformed very badly for over 10 years and where the valuations were at a cyclical low. Historically, valuations of PSU banks have moved between 0.5 price to book to 1.5 price to book, and they were available at 0.5 just 2 quarters back. So investors took money off from consistent compounders like Bajaj Finance or Kotak Bank and shifted that money towards PSU banks. But I think that trade will get over in the first 2 quarters of this year. And stocks like Bajaj Finance will come back strongly in the second half. Also, valuations for NBFCs like Bajaj Finance have corrected sharply. So Bajaj Finance, which was trading at around 35 times forward earnings to 24, is now trading at only 23 times forward earnings 24. And the profits have done quite well this year also. So we expect the profit of Bajaj Finance to go up from 7,000 crores last year to 11,500 crores this year, which is a 55% jump. But for PSU banks, the jump in profits is almost 100%, 150%. That's why this flow of money away from Bajaj Finance to PSU banks. But next year, we believe that post-June, PSU banks will have a growth of maybe only 10%. And next year, Bajaj Finance profits will again grow from 11,500 crores to 15,500 crores. That will again be a growth of 35%. And the year after that, Bajaj Finance profits will again grow from 15,500 crores to 21,000 crores. So Bajaj Finance profits will triple in 3 years. The PSU banks, after a very sharp growth in profits for the next 2 quarters, after that profit growth should slow down to around 10%. So we expect NBFCs like Bajaj Finance to come back very sharply in the second half of the year between June and December. That's what our view for the year is.
Thank you, Ajay sir. The next question is on commodities. So, as we have presented that China Open will have a positive impact on world economy in CY23. The participant is asking what will be the outlook on commodities in CY23. So here we believe that as China opens up in this calendar year, the commodity price will surely go up, but we will have to see the pace of rise in these commodity prices. So you have already seen some of the industrial commodities like aluminum and copper have run up around 10 to 20%, depending on which commodity you look at. So that is already, that trend is already happening in most of the commodities. But we believe that China is going to open up very sharply, and the major positive in that is, rather than looking at commodities, we are looking at some of the travel and leisure kind of stocks like Indian Hotel and these open up trades that we are looking at, that we have discussed in earlier presentations also. So as you rightly pointed out, the participant has rightly pointed out that commodities will have a strong year this year. We also concur with that view. The next question is on IT sector. How do you see IT sector's earnings panning out in this calendar year? And what is your view on IT sector? Uh, I request Rishikesh to take this question.
Thanks, Amit. So IT sector, recently, like Infosys, TCS, and Wipro, Tech also has delivered their results for Q3. So the results have been, in line, nothing great. But in terms of commentary, they have kind of, not, there's not that, except for the TCS, which is really upbeat. But others look little, there's nothing great about what the commentary is. So, so the expectation is that the valuations now have corrected. So, companies like TCS, which had the valuation of 34 times P last year, are now back to more of a range of 25, 26, 27 times. So which is much reasonable in terms of the valuations. But they are still above the long-term averages that they have been trading for last 8-10 years. So from that perspective, yes, there will be certain further price correction, but there will be more of a time correction for IT companies is what we feel. And I think investors should look at dips and buy these stocks because they are very good companies in terms of corporate governance, cash flow generation, dividend yield. Of course, the growth will not be as high as what we have seen in last couple of years, but yes, nevertheless, it will be a decent growth that these IT companies will deliver. Thanks.
Thank you, Rishikesh. The next question is for Ajay sir. What is your view on manufacturing sector? As we have emphasized in the presentation about the manufacturing sector contribution going up in terms of total contribution to GDP.
Yeah, manufacturing is among the core focus areas of the Modi government, and we believe that that will be among the best performing sectors over the next 5 years. Within that, we believe that defense will do very well because after the skirmish from China on the eastern border, we have seen a very, very strong focus of making India in the defense sector, and within that, we are finding that especially the PSU defense companies like HAL, BL, Bharat Dynamics, and some companies in the private sector also like Bharat Forge have seen very large defense orders coming from the government. Also, the government is very focused on getting logistics costs down because logistics costs in India are more than twice of what they're in China. And if we have to be a strong contender for manufacturing globally, we have to get these logistics costs down. We have seen the government focusing very strongly on railways to get logistics costs down. And there's been a very sharp increase in the budget for railways in the government's overall fiscal scheme. The third sector which should do well is the capital goods sector. So companies like ABB, Siemens, L&T have seen a very sharp rise in their order books because for the last 10 years, capex in India has been very low, especially private capex. So these are three themes in manufacturing which we think would do well. Thank you.
Thank you, Ajay sir. The next question is on how KSL is helping its investors to gain from the equity markets and how they are selecting the stocks. So here we are focusing on strong earning growth companies. So we focus on four or five major parameters, like the company should have a very strong moat in terms of competitive advantage compared to its peers. The company should be generating a very strong free cash flow over the last 10-15 years. The company should at least have a 20% return on capital employed. So this is the single biggest factor in our company selection parameter. If you see why India is also gaining more and more FPI inflows compared to China, that is why if you see Indian companies, the number of companies which are having higher than 15-20% ROC are very large in India. Compared to China, there are companies which are having only 10% kind of ROC in Chinese corporates. So that's why there is a stark diversion between the ROC of Indian companies and Chinese companies. That's why we are seeing a continuous inflow of money in Indian corporates versus China. At the same time, we focus on companies which are having a 20% plus operating profit growth, and we also diversify among the asset classes. As you have seen in our presentation, we look at gold, we look at global assets, like global equity markets like China, Nasdaq. These kind of investments also we promote. So based on our fundamental research and the strong technical research what we have, we will sell through and we will advise investors based on these all parameters. The next question is for Ajay sir. It is on your view on interest rates and why you feel that the debt products are having a good time in CY 23.
So my belief is that in India, RBI could increase interest rates by another 25 to 40 basis points. And in the US, we have another 2 rate hikes of 25 basis points each. But these have already been factored, and we believe that we are at close to peak interest rates right now, and see interest rates coming down in the second half of the year. So I think that these are very good interest rates to lock in long-term money, and we will not see this interest rates, in my opinion, for another 3 to 4 years. So if you also invest in government bonds which have a slightly longer tenure of 5 to 7 to 10 years, besides making the 7.3 to 7.5 return on the carry, you might also make capital appreciation. So 7.5% carry plus 1.5 2% appreciation. So this makes debt instruments extremely attractive right now. And I think between now to March would be a good time to invest in debt instruments. Thank you.
Thank you. The last question from the participant is about how do you see the auto sector reviving in CY 23? I request Rishikesh to take on this question.
Yeah, so auto sector, especially the commodity prices have kind of gone down. Crude prices have corrected. That will benefit auto is a big time. Thirdly, the supply chain issues have more or less sorted out. So from that perspective as well, the component availability has gone up, and that's the reason why things will be much better in terms of manufacturing in auto sector. Also, I would suggest that with all these, the pent-up demand has gone down a bit, but with the focus of electric vehicles, there is this revival in the sentiments, and that will keep good terms for the auto industry as such. The valuations still are not that high for, let's say, some companies like Mahindra and Mahindra for that matter, or even TVS Motors, but we should look at the companies which are really good in terms of cash flow and good in terms of managing their inventory and overall the product portfolio. So from that perspective, auto industry looks good. There are a lot of launches that a lot of these good companies, be it Maruti, be it Mahindra and Mahindra, TVS, have lined up for themselves, and which will keep the sentiment high. So we suggest that auto has a good time even going ahead. Thanks.
Thank you.
Now, can we call upon Ajay sir to give vote of thanks, please?
I would like to thank all our investors for joining us on this Saturday morning call.
Excuse me. I have asked some pertinent questions. Nothing has been answered about renewable energy sector, about realty.
Yes, sir. We will connect to your one-to-one visibility after this call. because the time got up. I'll just correct you on what to win immediately after this. And I look forward to connecting with all of you again on the next call. Thank you very much.
Thank you, investors, for patient listening.